early.
Okay, hold that thought. We want to bring in Tony Crescenzi, Chief Bond Market Strategist at Miller Tabak Asset Management. Tony, I don't know if you heard much of this discussion earlier. I was actually on my way up from the floor to the set here, and I heard Mr. Steve Liesman saying that this was actually the Fed, it sounded like almost trying to basically convince everyone that inflation maybe is more of an issue so that we could take some or distract away from deflation as an issue. Did you hear that, Tony, and what do you think?
Yeah, Steve is right. Bernanke is worried about a relapse, and it could easily be one. We're certainly not out of the woods. There's no such thing as a self-reinforcing expansion now. Of course, without the help of government, none of the process that we have now toward this upswing we have, this inflection point upward, would stick. It's not self-reinforcing in any way whatsoever. It's more.
So which is the bigger threat then, Tony? Deflation or inflation?
It still is deflation because of capacity utilization under 70%. It takes an 82% rate to have a higher rate of inflation. The unemployment rate would put downward pressure on wages for sure. One thing I worry about, though, is this rate of investment in the economy. We saw in the first quarter a 50% rate of decline in investment, a big drop in investment in structures like rigs, oil rigs. You've seen the rig count drop in half to under 1,000. We've seen a big drop in spending on equipment and software. It drops in investment, reduces supply of goods, and so it'll be more difficult to bring forth the supply that's needed when demand picks up.
But Tony,
yes, sir.
Let me ask you something, Tony. These are not monetary issues. These are tax and regulatory issues. You know, heck, I wouldn't be building any rigs, and I wouldn't be producing much domestic oil because I'm facing a big, fat tax increase, and I'm also facing regulatory, oppressive regulations that will not allow me to drill in the domestic U.S. ever again in my lifetime. In other words, you can keep pumping up the money supply, but that's not going to make businesses invest. What you will do is get yourself a devalued dollar once again, and then you'll have a commodity inflation, which will really damage the pickup in consumer spending. After all, it was the collapse of energy prices, Tony, that was a big tax cut for consumers. But let's not forget, it was the oil shock that was a huge tax hike for the whole economy. That's why I worry about the Fed pumping, and that's why I want Liesman to go in there and give those Fed boys hell. Just give them hell. Protect our currency. It's pro-growth.
Larry, what about the velocity of money? As you know, money is getting in the door of the banks, it's not going out. So I guess we have to, as Rick said, maybe wait till the feet start hitting the ground before we start to worry. But the velocity of money, as you know, is not moving. It's down.
But what about when PPIP kicks in? I mean, if PPIP is successful, if we actually see banks move all of these assets off, the toxic assets off their balance sheets into private investment pools, what happens then, Tony? Wouldn't that velocity of money start to pick up?
I would bet it would.
You should be so lucky to have that problem, Trish.
I got it. We got to get out.
It's good to have that problem, Steve? Is that what you said?
But Tony, let me just say,
we should be so lucky to have that problem.
Yes.
If we had all the problems you guys are talking about, you're talking about unemployment rate declining. You're talking about nominal GDP of 5 to 7%. If we had the problem of inflation, we'd know just what to do with it. The bigger concern is deflation, a harder nut to crack.
Okay.
All right, velocity is going to pick up when the economy picks up. We got to get out of here.